Hello, my name is Sandra, and welcome to my channel From Lack to Legacy. On this channel, we're all things money, investing, and mindset. In particular, how to go from a scarcity mindset to a mindset of abundance. If this sounds like something that you are interested in, or if you're trying to figure out, well, what the heck does all of that mean? Baby, you are in the right place. Um, Again, my name is Sandra. If you've been here before, welcome back. Hit the like and subscribe button, share the channel with somebody. If this is your first time here, welcome, welcome, welcome. Let's get into it. I have been gone off of YouTube for a month. So I'm not surprised that I'm in here by myself because I'm sure, well, and I also didn't even do like a announcement that I was going live. I'm just going live because I really want to share, I got so much to talk about. I just want to share what's been going on. Hello, somebody is in here. Hey, whoever you are, say hi in the chat. If you happen to have stopped by and this is your first time, welcome. If you've been here before, welcome back. Say hello so I know who is in here with me, so I'm not just talking to the air. But what the reason I came on live today is because if you don't know, I run a financial literacy learning community. It's virtual, it's all online. And we have been studying how to read income statements. And if you don't know what an income statement, hey, Zakia, if you don't know what an income statement is, you're in the right place because, I'll break it down and make it simple to understand. An income statement is one of three financial statements that corporations use, particularly companies. We're interested in reading income statements of companies that trade on the stock exchange, on the New York Stock Exchange, or they trade stocks. And so we want to be able to read their income statements because we're trying to find out if individual companies are a good buy. So there are three financial statements. One is the income statement, the balance sheet, and I forgot the name of the other one because that ain't what I came on here to talk about. But the income statement is really your profit and loss statement. And you can get so much information from that. So that's one thing that we're studying in our financial literacy community, how to read an income statement. The other thing that we're studying is how to do covered calls. That's why I'm on here today, y'all, because I have discovered a new toy. It's a new way to me, and it really isn't a new way even to me. A few years ago, I took my first trading class. I was living in Mexico at the time, and we would have all kinds of new traders, experienced traders would come on the live stream. And so when we were first starting out in my kitchen back in, I think it might have been 2021, 2022, a young lady, I think her name was C-Bar, I think that was her screen name. She would pop into the live and she was like, Sandra, I know you're teaching and you're learning how to do calls and puts. That's a options contract. We can go into that another time too. But she would always say, you need to learn how to do covered calls. Well, child, in the beginning, you're just trying to get the basics. So fast forward 3 years later, one of the ladies in our learning community brought up the topic of covered calls again. And so, of course, that sent me down a rabbit hole. And y'all, I am here to tell you covered calls are the way to go. It is an easy way to generate monthly income on stocks that you already own. So, one of the provisions or one of the prerequisites for trading covered calls is that you have to own 100 shares of a stock. And so, for those women like myself who are either retired or nearing retirement, or you have a brokerage account that you have agency over where you can make trades, you can invest your own money. If you own 100 shares of a stock, you could potentially make additional money. Of course, you want your stocks to be appreciating in value, but you could earn a little side income. Now, is it earth-shattering money? No, but is it safer than and simpler than other trading methods? Absolutely, yes. And so that's what I want to share today. So I'm going to share my screen. I'm going to share my Thinkorswim. So for those of you who don't know, in our learning community, we use the Thinkorswim platform. That is Charles Schwab's trading investing platform, Thinkorswim. So if you have Thinkorswim, and you want to follow along, if you want to learn along with me, because I'm still learning. But boy, over the last 2 weeks, have I learned so much. I made all the rookie mistakes, some that I was so surprised that I made, but I made them anyway. And I'm an open book. So I'm willing to share with you what I've learned, the mistakes I made, and then even some of the profits that I made. Because I made profits, honey, in the first 2 weeks. And I know if I can do it, you can do it. Of course, I'm trading out of my paper money account. And for anybody who's new to investing and trading, I would definitely say start in your paper money account. So give me a second because I'm getting ready to share my Thinkorswim, and I'll show you. Child, I have made, I'm gonna show it to y'all. Let me just make sure all my intel, all my information is covered and correct. Okay, so I'm gonna pull up my Thinkorswim. Let's see, I'm gonna share my screen and my window, Thinkorswim, paper money. Okay, so hopefully it says is requesting to bypass the system private, blah, 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 blah. Okay, so let me get over here and make sure. I need to see what you guys can see. Perfect. Okay. So hopefully you can see my Thinkorswim screen. And this is where it's kind of like the summary page of what you've bought and your profit and loss. And so I'm just going to start at the top and just kind of point to a few things. Okay. So we're under the monitor tab. And this is just an accounting. So you can see the first stock that I bought was Apple. I bought 100 shares because if you're going to trade covered calls, you have to own 100 shares of the stock. And so I bought 100 shares of Apple. At the time, it was $261.54. I'll have to look and see what it's currently trading at. Hopefully, it's up a little. I think it is. Then I bought 100 shares of Bank of America, and it was trading at 52.87 when I purchased 100 shares. I bought 100 shares of T. That ticker symbol T stands for AT&T, and it was trading at 29.06 when I purchased it. Then I bought, this is Ford. I bought 1,500 shares of Ford way back when Ford was trading at $10.50. Now it's hovering around 13, 14, between $13 and $14. It hasn't gotten to $15 yet. And you can see the profit that I've made. I've made $4,000 on those 1,500 shares. So that's a whole nother story for another day. Then I bought 100 shares of SoFi. I bought that. It was $20.56. And I bought 100 shares of Pfizer at $27.73. And I brought all of those in my paper money account with the intention to buy covered, not buy covered calls, to sell covered calls. And so there's a big difference between buying an options contract and selling an options contract. And so for this strategy, selling covered calls, and I hope I didn't say buying in the beginning, but if I did, charge it to my head and not my heart, because I am so excited to be sharing what I'm learning. Like all good teachers, we are lifelong learners. And as soon as we figure something out, we want to go tell. And so that's exactly what my aim and my goal is today. So these are the stocks. I flat out bought these stocks. These are not options contracts up above. And you'll see it says equities. So these are stocks that I actually own in my paper money account. And this is how many shares. This was the trade price. This is the profit loss for today. This is the profit loss open. That's the total profit loss. And this is the P&L percentage, what I'm up, what I'm down. So you can see, of course, I'm up 30% on Ford. And these others are down just a little bit. But I'm not really concerned about that. I'm not concerned about the performance of the stocks because I'm really here to highlight how you can, once you own 100 shares of a stock, how you can sell a covered call on the stock that you already own and earn money. So let's come down here. I'm just going to get to the juicy part. Then I'll back up and tell you step by step what I've learned about selling covered calls. So you can see T here is AT&T. And I actually sold a covered call with the 30 strike. The strike price is 30, meaning I agreed to sell this stock if it reaches $30. Well, that's great because I paid $29.06 for it. So if I have to sell it, I'm selling it at a profit. You can also see this quantity here, a -10. This is a mistake. I made a mistake, and I'm going to share that with you because I only own 100 shares. And the truth is, if I was doing a true sell of a covered call, this should be a -1. So we're going to go over that mistake that I made because I actually sold 10, and one of them is really only covered. The other 9, I just out there naked it. And if there are new traders, please learn from my mistakes. The biggest thing I could tell you is get on your paper money, practice, get in there. You can't hurt anything. It can't hurt. Get in there, try it. That's all I'm doing. And you will learn so much from the things that you do right. You will learn so much from the things that you do wrong. And so let me get back to it. So here's the first big mistake I made. I should have only sold one covered call, and instead I sold 10. And that happens because when you pull up the order form for this, it is automatically populated to 10. And I didn't check it before I hit send. But at any rate, so today, this contract, those contracts have lost $40, but overall, I've made $25, which is a 12% profit. I'm okay with that. Here is the Ford. I sold 10 again, and this was intentional because I own 1,500 shares. I could technically sell 15 covered calls, but I sold 10 covered calls. And today it made $15. Since I opened up this contract, it has made $60. And I think I'm going to close this out today because it's at 50% profit. We'll go over all of that. Then SoFi, I sold one. This is probably the riskiest one, or the one, again, I made mistakes on this one, but I'm willing to share. But I did get this right. I own 100 shares of SoFi. I sold one covered call, which is, it actually covers that 100 shares. And for SoFi, I've made $24 on that today, $14. So since I sold that call, covered call, I've made a total of $24 for a profit of 26, almost 27%. And then I did it again with Pfizer. I sold the 28 strike, a covered call, one contract. And so far I've made $13 on that, and for a total of about 28%. So if you total all of this up, 60, 75, that's 100, maybe $113. Now, is that earth-shattering money? Absolutely not. But you see where I am. I'm sitting basically in my pajamas. And so if I can make $113 on stocks that I already own, that's an additional $113. You know what I could do with $113? I could go buy some more. Let's see. I could go buy 2 more shares of Bank of America. AT&T is trading at roughly $30. I could go buy 3 more shares. So this is an income strategy. This is not a get rich quick. It's not a make big money. It is, how can I make additional income on stocks that I already own? And you can do this. The beautiful part about covered calls is that if I close these contracts out, I can do it again. You can rinse and repeat. So let me stop there and pause. Hey, brother, how are you? And hey, is that Miss Bayu? Good morning, good morning, good morning, everybody. I am so glad. First of all, every time I turn this thing on, I'm absolutely shocked when somebody else is on the other side. So if you're here, say hello. I see that there's 7 people. Don't forget, like, subscribe, share the channel. If you're just joining us, I am sharing with you everything that I learned in the last 2 weeks. So am I an expert? Absolutely not. But am I willing to share with you what I learned and the mistakes I made and all the rest of that? Oh, it's me. Hey. Oh, yes, it is me, sis. All right. I'm so glad you're here. Okay. So let's go back. Let's take it all the way back since I've shared with you um, what I've done in my account, let's take it all the way back to what is a covered call. A covered call is an options contract that you enter into. If you are the seller, there must be a buyer. And what are you selling? You're actually, think of it like this: you own 100 shares of Apple, and your shares are just sitting there, hopefully making money, hopefully just shimmying up the little, up the charts and appreciating in value. And you may, like me, I want to hold on to my Apple shares. I generally buy companies that I really like, that I think are fundamentally sound, and that I don't mind holding on to for some time. I would say that selling covered calls, you would want, that's my advice. That's what, and I don't get no financial advice, y'all, because I'm not a financial advisor. But that's how I'm doing it. These are companies that I wouldn't mind holding. In the event that I'm left holding these companies, I'm okay with that. AT&T, SoFi, Ford, Bank of America, and what was the other one? Whatever the five are, Pfizer. These are companies I believe in. So if I have to hold on to those stocks from now until I'm ready to let them go, I'm fine with that. Trading or selling covered calls, I probably would not do this with penny stocks. I wouldn't do this with companies that I don't like and I don't want to hold on to, because it is possible and conceivable that you will hold these stocks for the long term. So that's one thing. Pick companies that you like. There's some other things that go into picking the right stock to trade a covered call. And I would say that you want to pick a company or a stock that has good volume, meaning that lots of people are trading this. You need people to be trading in and out of it, because when it's time to sell, you want to know that there's a buyer on the other end. So you don't want a stock, they will call it has low liquidity, meaning you can't get in and out easily. So you want to pick, I don't want to say popular companies, but you want to pick companies that are traded often and regularly. You also want companies that aren't as volatile. You want some volatility. By volatility, I mean that people, they go up in price. There's some price movement, but you don't want one that's shooting up the chart and bouncing all over the place, because the thing with selling a covered call is that you're going to name a price that you would agree to sell your stock at, and hopefully you name a price that is above the current trading price, and you certainly name a price to sell that stock above what you paid for it. So those are some things, you want to consider. And if anything is confusing, drop a question. I'm happy to answer, because I promise you, I do get excited. When I learn something new, I get excited. When I have an opportunity to share it, I get excited. And when I can make some money, I get excited. So I'm definitely excited. So if I jump ahead or if anything seems confusing, just drop a question. I'm happy to go back. So how do you pick a good stock to sell covered calls on? You want volume, meaning there are lots of people moving in and out of this. They're selling it daily. You want moderate volatility. You want price movement, but you don't want a runner, because you are trying to name a strike price or a price that you're willing to sell your stock at. And you're hoping that it never reaches that price, because, I don't really want to sell my AT&T or any of them. But I am saying if it does reach that price, I will sell that stock to you and hopefully at a profit for me. So you want one that moves, but not too much. Something else. I'll leave it at those two, because if you really want an in-depth explanation, join our financial literacy learning community, honey, because I have prepped an entire full lesson on how to trade cover calls. We did it a week ago. And then we'll have another session the fourth Wednesday in February at 7 o'clock p.m. And I'll put the link in the chat. I'll find it for you and put the link in the chat how you can join us if you're interested. Hey, Nichelle, it's been forever. But I'm so happy to be here sharing this information about how to sell covered calls for income. And when I tell you, I swear I would not mislead you. When I tell you that this is probably one of the easiest options trading strategies you will ever come across. It is probably, there are no sure bets, but it is probably one of the most, not predictable, that's not the word, high probability. If you do it correctly, you have a high probability of making money. Now, are you going to be making $1,000 on these cover calls? No, this is slow drip money. But if you have a plan like most of us in our learning community have, which is we take these small wins and then we take those earnings, what we've earned from our trades, and we buy more stock. It's like getting free stock. I'm trying to give y'all the heads up on how you can buy yourself some free stocks. And what you're doing is you're actually leveraging the stocks that you already own. So let me back it up. In order to sell a covered call, you must own 100 shares of any stock. And so here are some that I've been working with over the last few days, and you can run it through ChatGPT. Hey, opportunity awaits. Welcome, welcome. You can run it through ChatGPT, Claude, Perplexity. You can go to Yahoo Finance, any of those sources, and simply ask, what are some of the best stocks to trade or to sell covered calls? And so here's what my research gave me. AT&T, Ford, they say Ford is the covered call king. And it's because Ford contracts are so inexpensive. They move in a range, they aren't shooting up the chart. They've got liquidity, meaning a lot of people trade them. So Ford is a good place to start if you want to sell covered calls. Are the premiums astronomical? Nope. By premium, I mean what you're going to get paid. Are you going to make $1 million selling covered calls on Ford? No. But can you make some steady money selling covered calls with Ford? Yes, you can. So Ford came up on my list. AT&T. SoFi came up on my list, but it was maybe number 4. And the reason SoFi, they said that you might want to hold off if you are new to selling covered calls, is because SoFi is pretty volatile. Meaning that price moves a lot in a day. And you can make money, but it's a little more stressful than Ford and AT&T. They've been pretty stable. Bank of America came up on my list. So all the ones that you see on the chart, those were the ones that came up on my list. And so I immediately went into my paper money account and bought 100 shares of each. Now, if you have a Schwab account and you have Thinkorswim, go now. Log into your Thinkorswim. Go into your paper money account and buy yourself 100 shares of Apple. Oh, Apple came up too as one of those stocks that are good for selling covered calls. You'll get a better premium, meaning you'll make more money selling those. But you also see that Apple is trading at, let me see, it's not cheap. Apple's trading at over $260 a share. Let me go to the chart and see exactly what Apple is trading at. AAPL. It'll pop up. Apple's trading at $263. So, if you're talking about 100 shares of that, just move that zero over 2 times, you're talking about $26,000. I don't know about y'all, but I'm not on here fronting at all. I don't have $26,000 to drop on Apple at one time. So if I were doing this in real life with my real money, I would probably start with Ford. So let's look at Ford. Because Ford is trading, I know for a fact, under $14 a share, or it's hovering right around $14 a share. So let's see what Ford is trading at. And forgive me, but I'm running a lot of stuff, so my screen is moving pretty slow. Let's go over to the chart. Ford is trading at $13.78. So if you wanted to buy 100 shares of Ford, just think about it. That's less than $1,400. Most of us got $1,400 where we could trade, we could trade Ford. You could buy 100 shares of Ford, $1,400, and start selling covered calls. So let me get back over here so I can see who's in the chat. Okay. So buy yourself 100 shares. Let's just start with Ford. And let me explain what you're doing when you sell a covered call. So what you are doing, you own 100 shares of Ford. You're the seller. If there's a seller, there must be a buyer. So what am I selling? I am actually more or less renting out my 100 shares of Ford. We're going to enter into a contract, and we're going to do two things within that contract. The contract has a start date and an end date. The end date is called the expiration. So we're going to pick an expiration date. That means that from the start of this contract to the end of this contract, I am going to lend you, the buyer, the person on the other side of the deal, my 100 shares of Ford. Now, if the price goes up, we'll talk about that. But that's the first thing that's going to happen. I'm going to pick an expiration date. And then I'm going to pick what is called a strike price. And the strike price represents the price that I would be willing to sell my 100 shares of Ford to you in the event that the price hits that strike price. So let me back this up. Let me give you an example. Ford is currently trading at $13.68. I'm going to go over to my monitor tab and show you the covered call that I sold. So I sold, if you follow right here, I hope you can see this. I have Ford. I sold a covered call with a strike price of $15. And what that means is if Ford's price hits $15, I would be willing to sell 100 shares of Ford at $15. Now, if you, like me, want to hold on to your shares, I don't really want to get rid of my shares. I am just saying I will lend you 100 shares of my Ford stock for a certain period of time. And you can see here's my expiration date. I'm in a contract that expires on March the 13th. So until March 13th, there's a buyer out there. I don't know who it is. I don't know who they are. But I said, I'm going to let you borrow my 100 shares of Ford until March 13th. And I'm hoping that it doesn't hit this $15, because if it hits the $15, I got to sell the stock. If it doesn't hit the $15, I get to keep what is called the premium. And what is the premium? The premium is what that buyer had to pay me in order to rent my 100 shares of Ford. So here's the whole contract. I'm going to lend to some unknown person out there 100 shares of my Ford stock until March the 13th. And I am saying, if that stock gets to $15, I agree to sell you 100 shares for $15. But look, y'all, Ford is currently trading at $13.87. My hope is that it never gets there, because as long as Ford doesn't get to the $15, I don't have to sell my shares. I get to keep them at the end of this contract, March 13th. I still get to keep my 100 shares, and I get to keep the premium that they paid me. The fact is, when you sell a covered call, once you sell it, you are paid a premium, which is the price that it costs for them to rent your shares. You get that premium into your account, cash money. The minute you hit sell and somebody buys it, you get that premium. This is the income that we're talking about. This is how you make the money. The premium is paid to you up front. And so you get to keep that no matter what. It doesn't matter what the price does. If the price goes up, the price goes down, shoots, it doesn't matter. If the contract expires, whatever that premium is that you got paid when you sold that covered call, you get to keep the premium. Now, let me just follow along. So here is what I made with selling that covered call on Ford. They paid me up front $120. Here's the trade price. It says 12, but we have to remember that options contracts come in lots of 100. So you would multiply this by 100, which would be $12. But I sold 10. So I got to multiply that 12 times 10, which is how I got paid $120 upfront. That money goes into my account no matter what. If we keep this contract all the way to the expiration date, which is March 13th, and the price never hits $15, I pocket and keep the entire $120. I hope that's not confusing. Let me explain to you how it's working, because I should have gotten out of here because it's almost at 50% profit, but we'll talk about that on another day. Y'all know I can't give it all to you. I just want to give you the overarching idea of how selling covered calls works. You own 100 shares of a stock. You agree to enter into a contract with a buyer. This is someone who says, well, let me borrow your 100 shares for a certain amount of time. You pick an expiration date. For new sellers of covered calls, and all of my research, it suggests that you sell somewhere between around 30 days, a month out, because that gives your contract enough time to, the price to work and do whatever it's going to do. So most of my covered calls were set at about a month out. Let me see. Let me get over here and see if there's anybody in here. Okay. It says, if you think it's going to hit $15, you can get out beforehand and make some money. Yes, I love that. Yep, you can absolutely. And so let me go back to that, because as I look at it, so here's my Ford cover call. It's already at almost 50%. I've made $55 out of the 120 that they fronted. If I wanted to, I could close this out right now and just take the $55. And the way you close this contract is, if you sell it to open up the contract, which is what I did, I have to now buy back this same contract, the same strike price of $15, and I'll buy it back at the price that it is selling at today, which is going to be less than what I paid for it. It'll work out to me getting the $55, which is almost half of the 120 that they put into my account initially. Now, if I allow this contract to go all the way to expiration and the price never hits 15, which is what I think is going to happen, and I'll show you on my chart why I picked a 15 strike. If I let this go all the way to March 13th, I keep the entire $120. If you don't want to wait all the way to March 13th, if you're greedy like me, you can take it. And I, from everything that I have learned and all the classes and videos and the people I've talked to, somewhere between 50 and 60% of the profit is a good place if you want to jump off. Because if you close it out, you can get right back in and sell another covered call. I could take this $55 today and tomorrow sell another covered call. Do you see the beauty of this rinse and repeat strategy? Are you going to be making $500? I mean, hey, if you got it like that, if you can afford to buy, 300 shares of Apple, maybe you can make that kind of money. But I'm talking about real people, working people. If you've got $1,500 today, you could buy 100 shares of Ford and start selling covered calls. You could actually do that. So yes, you don't have to wait until the contract expires. You don't have to wait to the expiration date. I could sell it right now. I could, let me slow down. I could close this covered call out. And the way you close it out is you buy it back. It's just the opposite. If you sell to open, you buy it back to close it. And I would just be buying it at its current price. So let me just pop over to my options chain. Here is my forward call. If I wanted to purchase it back today, you can see it's a fraction of the cost of what I paid. So right now it's $6, somewhere between $6 and $8. It would cost about $7 for me, and it's getting cheaper. It would cost, as time goes on, the contracts lose value. There's a lot going on here, folks. But I could certainly buy it back, and then that would close out that contract. And what they would do, because they've already put the $120 in my account, they would just take 70 out or whatever it is and leave me with the balance of $55. So let me go over to my chart and show you why. I'm going to put forward on a daily chart and show you why I picked a $15 strike for Ford. And I know this looks like a bunch of mumbo jumbo, but if you can see this, Ford hit a high of $14.50 back on January the 8th, 2026. And so let me make it smaller. Ford hasn't been above that price since January of 2026. So all of this, it's been trading historically less than $15. So let me pull out even a little more so you can see that Ford hasn't been above $15 in a year. So I felt reasonably safe that Ford would never get to $15 before that contract expires. So I picked a strike price. And again, the strike price is the price that I agree. If Ford hits $15, whoever the buyer is will probably what they call exercise, which means they will probably say, well, I want to buy your shares at $15. I would be obligated to sell them if the price hits $15 and the buyer decides that they want to exercise or they want to make good on this contract. But because I see, according to my chart, Ford hasn't been up to $15 in a whole year. Now, why would it go up to $15? Not saying that it couldn't, but I felt like that was a comfortable theory or thesis that it probably won't hit $15, and it hasn't. It's $13.84. And if you know anything about Ford, I'm going to pull this over here. Ford's ATR is about 30 cents, meaning it moves about 30 cents to the top or to the bottom in a day. It can go up 30 cents, it can go down 30 cents. Can Ford move 50 cents in a day? Yes. But on average, it moves about 30 cents a day. So if Ford isn't shooting up $1 a day, I felt reasonably comfortable saying, I will sell you my shares at $15 if Ford ever hits $15. Well, it's a win for me both ways, because when I bought the stock, when I bought Ford, I bought it at $10 and some change. So even if I sell it at $15, I make up that, I get that profit from the $10 to the $15. So let's just, for rough numbers, let's say that's $5 a share. I make that at the sale. Plus, I got to keep the premium. So I hope that's making sense. I hope that's making some sense. Hey, new life creator. Hey, I'm back. I'm back. I'm back. Okay. So there you have it. We're talking about how to sell covered calls, and why would anybody want to sell a covered call? Well, for many of us long-term investors, we have stocks, good companies that are just sitting in our portfolios. They're just sitting there, and hopefully they're earning something. They're appreciating in value. The price is going up, and you've got this slow kind of earning, and over time you'll realize, if you ever sell, you'll realize those goals. But in the meantime, while those stocks are just sitting there, you can make a little bit of extra income on the stocks that you already owned. And how do you do that? You do that by selling what is called a covered call. And why do they call it a covered call? It's called covered because you actually own the 100 shares. If at the end of the contract, or if during the time that contract is valid, your strike price is reached, the agreed upon price that you would sell, if it reaches it, you're covered because you own the stock. You're really just going to surrender the stock. It will pay for itself. Hey, see Tim. Oh, girl, I'm so glad you're here. We're talking about covered calls. Y'all know I'm excited. Oh my goodness. I learned a new trick and I can't wait to tell everybody. So, yes, please. And I'm telling you, Nichelle, I have some videos up, but you can just find a video about covered calls and start practicing in your paper money account. But I'll give it to you again, step by step. You start off by owning 100 shares of the stock. So that's the first thing you're going to do. Ladies, go to your paper money account and buy 100 shares. And I'll give you 5 companies that I'm working with. But do yourself a favor, just Google it, send it through chat, send it through Claude, send it through Perplexity. Ask, what are the 10 most popular or most profitable stocks for selling covered calls? Every time I ran it through, here's what came up. Ford is a covered call king. It came up on every list. Using Ford to sell covered calls. AT&T came up on just about every one of my lists. AT&T's ticker is T. Ford's ticker is F. SoFi came up on just about every one of my lists, but it didn't come up for beginners. That came up for, like, if you are an intermediate trader and you've got some experience under your belt. But I did it. I mean, I made some mistakes on it too, and I'll share those mistakes that I made. But SoFi is a good one. Bank of America came up on most of my lists. Somebody Google it right now. Somebody send it through ChatGPT and drop in the chat, what are the top 5 stocks for selling covered calls? Intel came up on one of my lists. Let me see what else I got over here, because I just pulled the ones that they recommended and immediately bought 100 shares and immediately start selling covered calls in my paper money account. So you can see I did AT&T, Ford, SoFi, and Pfizer. Pfizer came up as well. And so far, to be honest with you, my AT&T was up. You see, it's down $40 today. It was up $65. I should have sold. I should have, gotten out of this contract, because I would have been at 50% profit, but I had to walk my grandbaby to school. So I couldn't do it. I couldn't get out of it. But if I wanted to, I could absolutely close out this Ford contract and take the $55. I wouldn't want to close out this SoFi one because it's only a 23% profit and we've got some time on it. I've made $14 on this Pfizer and it's at 30%. So I would consider taking the profit, or I would consider closing out these covered calls when they get to 50% profit or better. And the reason I would do that is because I could rinse and repeat. I could do it again. I could take this $50 from this Ford, from selling this covered call with Ford, and then enter right back into another one, and hopefully earn some more money. So the first thing you do, go to your paper money account, buy 100 shares, okay? And so let me walk you through, how do you actually sell a covered call? And I have some more Ford stock available because I only used 1,000 shares. So I've got 500 shares left. So I'm going to walk you through how to sell a covered call on Ford, and we'll buy 5 contracts. And so because I like that $15 strike, I don't think Ford is going to reach $15 anytime soon. And here was how I came up with that theory. This is Ford on the daily chart. The highest it got, it rejected off of $14.50 way back in January. And for the last year, I could go back even further than a year. Let's go back even further. Let's go back 3 years and see when the last time Ford hit $15. Okay. Ford hit 1542 way back in 2023. You see? So do I really think Ford is going to hit $15? Well, it's only hit $15 once. Let's see. Twice. Once in 2024. Let's see. And then in Ford does not really, it don't play up there. It generally rejects around $15. And what I mean by reject is it'll get up to $15, but it doesn't stay up there. Folks not willing to pay $15, $16, $25 for Ford stock. It's just not the way the company is valued. And so I feel reasonably safe saying I don't think Ford is going to get to $15. As long as Ford does not hit $15, I can keep my shares. The contract will expire what they call worthless. It never happened. I get to keep the premium that the person paid to rent my shares for, till March 13th. No harm, no foul. They walk away, they lost the premium, whatever. I made the premium. Either way, I get to keep part of it or all of it. And so picking a strike is important. And the way I do that is I look back historically, and what is likely not to happen. It's not very likely that it'll hit $15. So I'm going to stick with that $15 strike price. So I'm going to come over to my trade tab and I'm going to show you exactly how to sell a covered call. So here we are on the Ford options chain. Let me collapse it so you can see it. So here's Ford. I came to the trade tab. This is the options chain. And all of these dates are expiration dates. Ford has contracts that expire in 1 day. Those are, that's like they expire tomorrow. So you've got contracts that expire in 8 days, 15 days. When I bought this contract, it was about 30 days because I think I've had it for maybe a week. I don't know. I have to look back and see. Or you could go with this date. Let's do this one. This is 29 days from today. So I want a contract that's going to give some time. I don't want those that go quickly because let's just say I'm just going to get one that's out there 30 days. So I'm going to hit this caret. It's going to open up this the contracts on my options chain. Now I'm going to look at my delta, which helps you determine the likelihood. I know this is a lot of jargon, but hang with me, of these contracts expiring in the money. I don't want it in the money. So I'm going to pick a delta somewhere under 30. This one has a delta of 22. That's fine. Then I'm going to look at the bid and the ask. This is the premium that you will get paid. So the bid is what we're going to click on in order to start to open up this cell of the covered call. So I would tap on this, and I don't want to pay the highest price, or, well, let me say this. Let me back up and slow down. You could get the premium somewhere between 40, well, now it says $41. That's what you're going to get paid, somewhere between $40 and $41. I usually go right in the middle, so I would probably go 40, 50. $40.50. Because remember, each contract controls 100 shares. So I have to multiply 40 by 100, just move the decimal point 2 places. If I sell one covered call of Ford, I would get a premium paid to me of roughly $40. Well, remember, we've got 500 shares. So I'm going to sell 5 contracts, and then we'll see what the premium is when we do that. So to open it, I hit this, I hit sell, and then I'm going to come down to, I hit bid, I'm going to hit sell. I'm going to go up here to single. And when I hit single, this order form opens up below. Here's the mistake I made. Do you see how this says minus 10? It's automatically populated to 10. You have to pay attention to that because this is saying I want to sell 10 covered calls. I do not, because I only have 500 shares. So I'm going to move and change this to 5. So now I'm selling 5 contracts of Ford with an expiration date of March 20th, which is roughly 30 days. And that's the 14. I don't think I want that one. I think I want the 15. I think I want the, oh, no. Maybe I'll do this one. I'll do the 14.85. And I'm telling you, let me tell you why I'm changing it to the 14.85 strike, because of the delta. This one pays a better premium, but I don't like that delta. The delta says that it's a 47% chance that this thing could hit $14. Well, yeah, because it's so close to $14. I wouldn't fool with that one. But 14.85, that's $1 away. It's a 22% chance that it'll hit this 14.85. You're not going to get paid as much in the premium, but I'm okay with that. Yeah. I think I feel better about this one. And I probably wouldn't pick the 15 strike at this point because of the premium is so low. So I think a happy medium would be maybe go to $14.85, because my thinking is, how likely is it that Ford gets to $14.85 in the next 30 days? So I'm going to select this strike, but you could pick the 15 if you're okay with receiving just, what is that, $10 in premium or $11 for each covered call that you sell. But I would probably go with this one because it's a little bit more, and you see the prices changing constantly. And so I'm going to go with this strike, 14.85, and then you'll see it change right down here to 14.85. And so here's the price. Is it still changing? Let's see. 13, 14. I'm going to leave it at that. I'm going to leave it at a limit. I don't want to do this as a market. I want to name this price. This is what I can expect to be paid. So it says 13. And of course, you're going to multiply that by 100. So it's $13 per contract. And since we have 5, that's going to be what, $65? 50 plus 15, $65 is the premium that we could expect to be paid on this contract. So let me just skip over here and see if anybody has a question before we go. How far out do you go for the strike date? I normally go out 30 days. So yes, that's called back testing, right? Okay, let me go back in. Okay, somebody said today, chat is saying Johnson & Johnson. I saw that one too. Procter & Gamble, Verizon, 3M Company, and Microsoft. Yep. Ask in Claude too. I'll ask again to see which companies. Oh, you know why too? I said I wanted companies that were under $50 to make it affordable. So see if you add that stipulation, like what are great companies to sell covered calls on under $50? Only because if you're doing with real money, you want to be able to get in. Let's see, with the surge in EV and the trash economy, why would Ford stock rise though? That's what we're talking about. Why, Ford's price isn't going to be shooting up. And so Ford does, I think, make it an easy, safe, calm kind of covered call to sell. You don't have to worry about the price shooting up and biting your nails. How far out do you go for a strike date? I normally go about 30 days out. Microsoft just lost a bunch of government contracts in Europe. Not sure if that had any impact yet. I don't know. It'll be interesting to see. Okay, so let me finish up selling this covered call. So we are selling 5 contracts. You see the negative means we're selling, and it's red when you sell, it's green when you buy. We picked an expiration date that's 30 days out. We picked a strike price that we don't think Ford is going to reach in the next 30 days. But you know what? If you don't care anything about selling your stock, if you're not interested in holding on to the stock long term, hey, pick a strike, a lower strike price. You get more premium, but you have a higher chance of it reaching that price and you having to sell your stock. But if you got it at a good price like I got at $10, what do you care if you sell it at $14.85? You see? So I think you have to kind of weigh it out for yourself. Do you really want to hold on to that stock so that you can rinse and repeat? Or are you okay with selling your stock at a price higher than you paid? I'll tell you one of the mistakes I made, and I'll show it to you. I purchased SoFi for $20.65, something like that. And I sold a covered call with a strike price of $20, agreeing to sell my SoFi at $20. I'll show it to you. Rookie mistake. Don't do what I did. Hold on, Lord. Wait a minute. I'm granny on duty, so let me make sure this is not my grandbaby calling me from school, y'all. Hold on. This real grandma time. Where's my phone? Can't see who it is. Okay, well, whoever it is hung up. It can't be my grandbaby because my grandbaby will call till I answer. Okay, wait a minute, y'all. Let me check it out because I am seriously grandma on duty. Oh, I think that was my baby sister. I'll call her later. Okay, so let's finish it up. So I'm agreeing to take this premium right here of $13. But because I'm selling 5 contracts, it's going to be 13 times 5, which is $65. I'm going to hit confirm and send, and you'll see all of this in the order confirmation. So let me see if y'all can see my order confirmation. Okay, I need to share that. Hold tight. Stop. I'm going to share it again. Hold on. Share screen. Window, order confirmation. Okay. Now, can you all see my order confirmation sheet? I hope you can. Let's see. Okay, there it is. Once I did that, this is what it'll say. So you want to make sure that you read this before you hit send. It says, I'm going to sell 5 contracts of Ford with an expiration date of March 20th, and the strike price is $14.85. At this 13 right here represents how much I'm going to be paid in premium per contract. So here's our expiration date. Here's our strike price. The strike price is $14.85. So if Ford hits $14.85, I'm agreeing to sell them 500 shares at $14.85. Why am I okay with this? Because I only paid $10 and like 50 cents. So I would make $4.35 per share. Multiply that by 500. I'm okay with this. I don't want that to happen because I want to keep my shares so that when the contract is over, I can sell another covered call. But if I get caught and it reaches $14.85, I'm okay. So it's important to pick a strike price that is above the current trading price and above what you paid for it. I learned all this the hard way, y'all, because I made stupid, silly mistakes. Okay, so it tells you right here your max profit is $65. Again, we get paid $13 for each contract, and we're selling 5, so that's $65. And then, of course, they're going to take out 65 cents for each one of those contracts, which comes to, that's the fee you pay, $3.25. So actually what's going to go into my account right now when I hit send is $61.71. I get to keep that premium no matter what. Did you see I just made $61 sitting on my phone, sitting here talking to y'all on the thing? I just made $61. I get to keep the premium no matter what. The only way I would get less than that 61 is if I decided to close this contract out before it expired. I could agree of my own volition to just say, I'm going to take $30. When it gets to be $30, I could sell it back. I could buy it back and just take 30 something dollars in profit. But if I let it go to expiration, no matter what happens, I get to keep the $61.75. So I'm going to go ahead. I got to make sure I'm in the right account, which is my margin. And then it says create covered call strategy. I'm not doing any of that. I'm going to go ahead and hit send. And I'm going to wait for it to fill. And it's working down here. So we'll see it once it fills. Okay. So let me get over here to the month. It just fell. Did y'all see in here? So it just says sold, and it's filled. And so let me go over here to the monitor tab, and then you'll be able to see it. Okay. So let me go over here. I got to make sure y'all can see it. So let me share my screen again. Okay. Can you see it? Okay, so here's what we just did. I'm going to close this up so it doesn't look so junky. Here on the monitor tab, I come down to options and you'll see this is the covered call I sold for AT&T. Here's the one I sold for Ford. And this is the one that we just did right here, the 1485. We sold 5 contracts and we just made $2.50. Just like that. So we're up 357. I'm sorry, 3.57%. And I keep watching these other ones to see, if, what we're making. Because once they get to be about 50 or 60% profit, I'm going to probably close them out. But at any rate, so if we close all of this out right now, we would take $45, $45, $250, $22.50, and 16. It's not earth-shattering money, y'all. But while I'm sitting here chatting with you on the internet, let's learn to get these cover calls, y'all. Okay. What is the difference between the accounts? One is a margin account and the other is an IRA. Okay. A margin account, which I don't really recommend for new traders. Oh, I wouldn't recommend a margin account for anybody unless you just like to gamble. But a margin account is an account where you don't necessarily have to have that money. They will lend you money. See, Tim, yes, I love consistent money too. It don't have to be big money, but if I can make this money like this, $65, $75, girl, count me in. Close out all those contracts and do it again. That's the easiest money I ever made in my pajamas. But Nichelle said, what is the difference between the accounts? One of mine is a margin account and the other is just a plain IRA. It's just a plain brokerage account. It allows me to trade in it. But once my money is gone, I can't make any more trades. That's it. You can only trade with the money that you have in your account. If you have a margin account, they will front you money for particular, some trades. Now, they're not giving you that money for free. They are charging you interest on that money. So it's kind of like your brokerage will give you a loan, and they call that a margin. But you run the risk of, if a trade goes against you and you're down $800, they want that money. You got to pay them people. So I don't fool with it. I do it on paper money. only because I didn't reset the values. If you've ever worked with paper money, I think your account starts out with 100,000 or 200,000. And in my IRA account, I didn't know how to reset the money. So I just switched over to my margin account. But that's what a margin is. It's when they agree, the brokerage or whoever you're trading with, that platform agrees to front you money at a cost. They charge you interest. And so you could rack up a, pretty hefty bill. You better have that money on hand somewhere. If they lend you $900, I don't know how much time they give you to pay it back, but I don't fool around with it even. I would never fool around with a margin account personally with my real money. That's me. Plenty of people trade on margin. It is what it is. Okay. SoFi, I see somebody put in the chat. SoFi, DraftKings, Ford, Intel, AT&T, Verizon are under $50. Yes. These are stocks that if you own 100 shares and you're interested in learning how to sell covered calls for income, you might want to consider do them in your paper money. Right now, go buy 100 shares of SoFi, DraftKings, Ford, AT&T, and Verizon. It's paper money. We're rich in paper money. I mean, you can buy as many as you want, but start there. And then I'll walk you through one more time how to actually sell the cover call, um, the actual steps that you take. Is it possible to make $100 a day? Yeah. I mean, like if you own, let's say, I'm just saying, potentially, yes. Let's look at what you could make in premium if you were selling covered calls on Apple. Apple pays better premiums because the stock is worth more. And I love C-Temp's answer. She said, you need a margin account for more complex trades like verticals and straddles. Y'all, when I tell you we are doing the baby strategy, I think it's probably one of the easiest options trades with probably the least amount of risk that you could do. I think it's a great beginner trade because you manage your risk by owning the 100 shares. Let's go to the worst case scenario. Let's say the worst case happens with those calls that we sold. Let's say the $15 one. Let's say the price absolutely shoots past $15 and it goes up to $16. Here's what happens. If it goes up to $16, of course, the person who bought it from me, they're going to want to exercise that. They're going to be like, oh, girl, this is good. You agreed to sell me your shares for $15. The price is now $16. Of course, they're going to want to buy 100 shares from me at $15 because they are now worth $16. They automatically make up from, I get the profit up to the $15, but they get everything above $15. So, of course, if the worst case scenario for me, it's not even a worst case scenario, but let's just play it out. If Ford's price shoots past $15 to $16, I am obligated to sell my shares to the other person on the other side of this deal for $15. I still get to keep the premium, but I am out of those shares. All of it happens automatically. You don't have to do anything, honey, because trust me, it happens almost automatically. And the person who's on the other side, now most people who buy options contracts, they're not trying to buy the shares, they just want the money. Remember, he rented them, or whoever's on the other side of the deal rented 100 shares from us for 30 days. So they're hoping that it gets up past $15 because anything above $15, they get to take that in profit. So that's the flip side of the deal. I personally, if you pick the right strike price, you're going to be okay either way. Because remember, I picked a strike of 15 because I paid $10 for the Ford shares. So I'm okay. I made $15 on each share. I could have made 16. So when you sell a covered call, you kind of cap your profit. I cut myself off at making $5 in profit per share. But I also got to keep the premium. So I guess you could call that the worst case scenario, is that you get what is called assigned. You'll hear that language, oh, your contract got assigned, meaning your shares go away at that agreed price. So somebody said, could you make $100 a share a day? Let's look at it. Let's look at some Apple calls and see what those premiums look like, because I think you could. Okay, so I'm going to go over to the trade tab. I'm going to come down here and put Apple into our options chain. And let's look at I want to see if Apple has some contracts that are 30 days out. Okay, here's one that's 29 days out. So let's see what those premiums look like. What could you potentially get paid? Okay, so let's assume that you own 100 shares of Apple, and I'm going to use my own account for this. Let me just go back. I need to see what I paid for Apple. Equities. I paid $261 for each share of Apple, meaning I need to pick a strike price. If I was going to do it, my strike price has to be above 261 because I don't want to sell my shares at a loss. So I'm going to be looking at a strike price that is above what I paid, number one. So let's go back over here. And here are your calls on, this is my left, on the left-hand side, and here's where the strike price is. So when I say strike price, the strike price is the price that you agree to sell your shares. If the price gets to $265, then I could, I wouldn't do this one because I don't like the delta on this. Remember, I'm going to get a delta somewhere between 20 and 30 because this is really saying the probability of Apple's price getting to 280 is about 20%. The probability of Apple's price getting to 275 is about 30%. I like those odds. I don't want no 50-50 business, although you could get more in premium. But I'm going to pick, so let's say we're going to be daring and risky. I'm going to pick this one. This is the 275 strike price. So I'm saying in the next 30 days, I'm really hoping and praying or theorizing that the strike price will not, Apple's trading price will not get to $275. And so we're going to sell this covered call. I would need to buy some more, but at any rate, here's what you could expect to get paid. This says $3.20. We're going to move this decimal point over 2 places because remember, options contracts control 100 shares. So you could potentially make, and right in between here, here's the highest price, the lowest price, 330, 320. So I would probably go for the mark, which is somewhere right in the middle, 325. So let's just say we were going to do it. I'm going to just walk through it so we can see it. I'm going to hit the bid. You're going to see sell. I'm going to hit sell. I'm going to go up to a single, and this pops open. So I'm going to sell. I'm not going to do 10. I'm going to make this 1. And it's Apple. Here's the expiration date, the 275 call. And what I'm saying is that I don't think Apple's price is going to get up to 275 in the next 30 days. And here's what I'm willing to accept in premium, $325. So let's confirm and send, and let's read that order confirmation. So let's see. I'm going to have to stop sharing to pull in the order confirmation sheet for you guys so you can see what it says. Share screen. So someone asked, can you make $100 a day selling covered calls? If you got a stock like Apple, you can. And I'm not saying that you can make that in a day, but this is the premium that they're going to put into your account. Now, here's what has to happen. You keep the premium no matter what. You keep that 325 no matter what. And I've picked a strike price of $278.25. Remember, I paid $261 for my Apple shares. So the worst case scenario, the stock hits this price, $278.25. I have to sell my shares to whoever the buyer is for $278. I'm okay with this. It might not be what I prefer, but I only paid $261 per share. So I'm going to make the difference. I'll make up to this $278.25. Plus, I get to keep the premium. Now, do I want to sell my shares? No. Am I hoping and praying like all heck that the price stays under $278.25? Yes. But even if it does, I still profit the difference between 261 and 278. Let's just say roughly $15 a share times 100. That's $1,500 I would profit. But I'm out of those Apple shares. So, now you don't have that potential growth anymore. And then I get to keep the 325. Well, heck, if all push come to shove, repurchase the shares. If you sell them at 278, jump right back in, buy you some more. You still get to keep the premium. It's not what I want. I never, if I own Apple, I want to keep it. So I would hit send. When I hit send, 325 goes immediately into your account. Now you got to wait potentially the 30 days, then you get to keep all the premium if the price never hits 278. Let's say 15 days in, it doesn't get to 278, but it's showing that maybe you've made $200 of the 325. You could close it out and say, well, I won't even wait to get the whole 325. I'll just, I'll buy it back to close it out and keep the difference. I know that's a lot, but at any rate, I'm going to do it anyway. I'm going to hit send anyway. Even though I don't have another 100 shares of Apple, I should go buy 100 shares real quick. But at any rate, I hope that made sense. So can you make $100 in a day? Yes, you could make $100 in a day. But think about the capital that you would have to have if you're just starting to buy 100 shares of Apple. Apple's trading at $270 a share. Multiply that by 100, that's $27,000. But here's the good news. Some of y'all are sitting with this kind of money in your retirement accounts. And if you have agency over your retirement account and your 100 shares of Apple are just sitting there and you can sell a covered call, why wouldn't you? Some of you have brokerage accounts where you have 100 shares. So all I'm saying is that this is something, if you have never done it before, you might want to consider practicing in your paper money account before you do it with your real money. Somebody said, great explanation. When and where did you pick up this strategy? One of the ladies in the community, I'd actually seen it. And C-Temp, I don't know if you remember this lady, but I think her name was C-Bar. Her screen name was C-Bar or T-Bar, or it was something. And she would come into our chats early on and she kept saying, you all need to sell covered calls. And I'm like, girl, we don't sell. We barely know how to buy. And she kept saying, you need to, do these covered calls. I got my hair twisted, y'all. And I was like, yeah, I don't have the bandwidth to learn another strategy. So who brought it up? I want to say it was Shauna. Shauna brought it up in the learning community. And so we just started. So we started almost 2 weeks ago at our last study session, practicing covered calls. And so, yeah. Okay. Somebody said, can you simulate buying it back? Yes, I'm going to do this for y'all. So I'm going to show you how to buy back with my account. I'm going to go ahead and sacrifice. Let me get over here. I'm going to sacrifice my Ford. Let me pull it back in. and I'll take profit on my forward ones, even though it's not 50% yet. Because it's just paper money. Okay, so I should hurry up too because, okay, so Ford, you see Ford just, we were at $55 in profit. And you see we lost $5. We were at $45. So I'm going to go ahead because it's the one that has the most profit. Can you all see that? It's 33%. So we made a third. They put $120 premium. When I first sold this covered call, they put $120 in my account. And now you can see we're up to $45. So we're at 37. Did you see that change real quick? Which means of that 120 in premium, we have really secured $45 at this point in the contract. What I'm going to do is buy this back. And I won't, they put the 120 in, but what I'm going to really get to keep is the $45 because we're closing this out early. So how do we do that? We can create, let me see if I can do it from here. Create a closing contract, create a closing order. Let's see. Yep. Can you all see that where it says buy 10? Because remember, you sell a covered call to open this contract, you buy it back to close it. So I'm going to go ahead and hit buy, and you're going to see this here. Oh, this is so lovely. Oh, this is beautiful. So buy 10 contracts. This is our expiration date. Remember, it was March 13th at the 15 strike. It's a call. But here's what I'm paying for it. I am now paying $80 because remember, we got to move up $8. And I'm paying $8 per contract. And because I have 10, I'm going to wind up paying $80 to close it out. Well, remember, they put 120 in my account. So when I buy it back, that 80, they're going to take the 80. So I net 40. I hope that makes sense. And Ford keeps jumping around. So I'll net somewhere between this $40 and $45. So let me go ahead. I hope that makes sense. Okay. That's one way to do it. I could confirm and send, and then it'll give me that order box. So let me just take my time and walk you through the order confirmation box. Okay. I got to pull this out and then do the order confirmation one more time. I wonder if I can, let me see. I'm going to stop sharing and then reshare the box. Share screen, share, order confirmation. Okay. Can you all see this order confirmation? It says buy 10 contracts of Ford with the expiration date. That's the original call. The strike price was 15, and it's going to cost $8 a contract for a total of $80. So look, they're going to put this back into my, well, yeah, it's going to cost me $80 for this. That's what I got to pay. So really, and I got to do, since it's another, oh, look at this. I'm glad we did this because every time you do this, it's 65 cents. So it's really going to cost me $86.50. That's why I think it worked out to be like $40 in profit because we're going to pay that $6.50 as well. So $86.50 is what it's going to cost me to close this out. They gave me 120 up front. I'm giving 86 back, but I get to keep whatever that difference is. So let me go ahead on and close it out. But before I do, I wanted to show you all something else. I wanted to show you another way because I did it from there. But you could do that. So I'm going to save it. I could do it from the options chain too. So let me show you how to close it out from the options chain. Okay, so let's say I didn't want to do it. I'm going to get rid of this. I'm going to delete this. Okay, and so I'm still in this for where we've made this $45. What I'm going to do is go over to the trade tab. Here it is right here. Let me go over to forward and put forward up here. Forward. And this is the, let's see, that's 26. We want this one. We want the one that's scheduled to close or expire on March 13th. So just like we hit the bid to sell, we're going to do the ask to buy. I don't know if you can see when I hover over ask, you see the little word buy. And again, you can see it's going to be $8 for each contract. You see that? $8. And so we did 10, it's going to be $80. Or I could try to get it for $750. I could get somewhere between the bid and the ask. So let's just try it. I'm going to hit buy because we're going to buy this back. What? Uh-oh, wait a minute. Wait. Buy. Come on, thing. Okay, there we go. Did it pop up so y'all can see? I have to scoot over here to see if what y'all can see. Okay, cool. So same thing. I just wanted to show you that you can initiate the buyback from the options chain, or we could have done it right in that P&L statement. So same thing. We're going to buy back the 10 forward with that expiration date, the call, ba-ba-da-ba-da-ba-da-ba-doo. And let's see. Right now, I think it's just 8. Nothing I can do about it. It's going to be $80. Confirm and send. Every time that order confirmation box comes up, I have to I have to bring it up again. So share screen. Okay. So here's our order confirmation. Same thing, 86.50 is what they're going to take out of my account. They put 120 in. They're going to take 86 out. I keep the difference. So I'm going to hit send. And we'll see it you'll hear it when it closes out. And there it is. It's gone. So let me go back and see what it looks like in our profit loss on that monitor screen. So let's go back. Okay. So let's go back over to the monitor tab and you'll see that it is gone. You remember we had 2 forward. This is the one that we just bought, the 1485 strike. The one that had the 15 strike is gone. But I think if I go up here, you can see this is the order history. You can see where it filled. We sold. I'm sorry. I have to be careful the language. We bought back those 10 contracts. You can see it says filled. Now, up here somewhere is where the money moves. I have to, let's see, trade history. Activities and positions. I think this is it, where that you actually see where the money is moving. Where was that? I'll find it, you guys. But there is a tab, account statement, where you can actually see where they're crediting. Okay, here it is up here. There it is. Bam. Okay. So if you go up here to the top, you can see all of the things that were executed today. It says executed 219, and it shows you, here's what we just did. We bought these 10, with the 15 strike. And here's what they took out of my account. They took $70 out of the account. So they put in, that's even better than I thought it was going to be, because they put in 120 and they took 70 out. So, and they took out these commissions and fees. So they took out $76 out of that 120. So that's how you close it out if you want to close it out early. Ciao. I hope that helps. Listen, if you need some more support, y'all know where to find me. Just come. We're doing, we do this every other Wednesday. We meet the second and the fourth Wednesday of the month. Let me put the link down in here. Let me find it first. Let me copy this link. Hold on. I don't know if y'all can see my screen and see everything that's going on or not, but hold tight. Let me grab this Calendly link. I would love to have anybody who wants to come join us. Please feel free to join us. When I tell you the only reason that we started doing this work is because somebody in the community brought it up. I have heard of covered calls. I understood that it was one of the easiest, most beginner friendly options trading strategies. I had heard that it was a high probability trade, all of those things, but I didn't jump in. So, it was another sister that encouraged all of us to just give it a try. And so that's how it works. I don't know everything. Y'all know I don't. Y'all been watching me learn in public for 3 years. I've been learning. I'm constantly learning other things. But the beauty of being in community with other people is that you don't have to know it all. Somebody sitting next to you knows more than you. And that's why Black women are magic, baby, because we don't gatekeep. So as soon as I learn it, I'm on here giving it to y'all for free because somebody brought it up to me. And so if you want to really get into it, if you really want to practice in community, join us. I would love to have you. Could you see it, Nichelle, when you put it on the big screen? Could you see it? I would share with y'all, well, in our learning community, we have a Google Classroom. And so there's a slide presentation, there are videos. Hey, Mara. Hey, girl. Hey, girl. Hey. Another one of my travel sisters doing big things out here in the world. Y'all wish Mara the best. She is headed to Mexico if she isn't already there. And I hope I ain't telling too much. But my sister is doing big things. She's making big moves. And I think we could all use positive energy, love, support. And so, sister, I got you in my thoughts and prayers. I know everything is going to be beautiful. And anything that falls short, you've got it. You've got the strength. You've got the community behind you to face anything. So you already winning, sister. And I wish you the best as as you journey on and step out into new places and spaces. So y'all give Mara some love in the chat because she's doing some moving and some shaking. And when I tell you this is a young sister who is out here taking, big steps. It takes a lot of courage to make changes, the kind of changes that she's making. And so I'm so proud of you, super proud of you, sister. And you are always welcome. Those folks who paid to join the community, I always try to make sure that you have access. You always have access to our Google Classroom. You can take advantage of the recordings of our study sessions. And so if you haven't joined, what you waiting on? Come over, make us better. We are so much better together. I'm telling you. And if there's something that we welcome experienced traders, novice traders, and investors. If you've never done anything before, you with your group. You with your group. So just to recap, today we talked about selling covered calls. Why would anybody sell a covered call? You can generate income with stocks that you already own. Is it earth-shattering money? Nope. Is it easier money? Yes, it's absolutely easier money. It's less risky than, say, buying naked calls or naked puts. So how do you sell a covered call? The first step, you have to own 100 shares of a stock. Let me make sure. Hold tight, y'all. Wait. I'm going to stop sharing my screen because I just noticed something. But at any rate, you have to own 100 shares of a particular stock. And there are some stocks that lend themselves better to covered calls. And the ladies listed some in the chat. And I'll just scroll back to tell you some that came up. If you don't own them, start working toward getting 100 shares. SoFi is trading around $20, just under $20 a share. You could get 100 shares of SoFi for, is that $2,000? Yes. Ford is trading under $14. You could get 100 shares of Ford for under $1,500. AT&T is currently under $25 or roughly around there. So for $2,500, you could buy 100 shares of AT&T. I don't know what Intel is trading at or Verizon, but they're all under $50. So for under $5,000, the first thing you want to do is acquire 100 shares of a stock. Now, once you own 100 shares of the stock, in essence, what you're going to do is be lending them out. You're going to put them to work. You're going to put them on the streets. You're going to take 100 of your shares and you're going to sell it for a certain amount of time. And that time period of that contract, it has an expiration date. So if I open it up today, you'll look on your options chain. You could do it 30 days out. That would be my recommendation for new people, folks who are just starting to sell covered calls. Oh, Nichelle said Verizon is currently trading at 48.73. Okay, that's cool. Still, you could get 100 shares for under $5,000. Let me pause right there, because some of you have brokerage accounts. You may have an IRA. You may have a Roth. I think you could do it in a Roth too. Check with your broker. Check with whoever manages your fund. If you have autonomy to invest, to buy and sell, inquire if you can sell covered calls in the account that you already have. That was what blew my mind. So you may not even have to buy 100 shares. If you currently have a brokerage account and you already own 100 shares of a stock, ask. If not, then if you got $2,500, check out some stocks that are under $25 a share, buy 100 shares. The next thing you're going to do is practice in your paper money account. I would never tell anybody go run out in the street and use your real money. Don't do it. Because I made some mistakes, and I've been like investing and trading for a while. I made a rookie mistake. I did not check the box, and instead of selling one covered call, I sold 10. Easy mistake. So before you do any of that, practice in your paper money account. But in essence, you're going to lend out 100 shares of your stock for a certain period of time. When you do that, the person that you're lending them to, they pay you for the privilege. That thing is called a premium. They pay you the premium the day you enter into the contract. That money is yours no matter what. If you let the contract just expire, you hold on to the entire amount of the premium. You're going to select what is called a strike price. The strike price is the price that you agree to sell your stocks in the event that the stock price reaches that level. So if we pay $10 for Ford and we sell a covered call with a strike price of $15, we're agreeing to sell our Ford shares at $15. Why do we care? If I pay 10 for them, if I sell them to you for 15, the only reason you might be salty is that Ford shoots up to $16. Well, you don't get to get that other dollar in profit. You only get the profit up to $15. The person that you sold the call to, they get the rest of it. That's why they enter into the contract. And it's cheaper for them than buying all 100 shares of the stock. Everybody knows when you buy an options contract, it's cheaper than buying all of the shares. So they put up a little bit of money to buy the call that you're selling. Yep. And they get the opportunity to capitalize on any price appreciation above your strike price. It may happen. It may not. If it never reaches your $15 strike, guess what? You keep your shares and the premium. And when the contract expires, you get to do it again. And so many people are using covered calls to generate additional income on stocks that they already own. So here's some things that we didn't talk about. Anytime you make a profit, Uncle Sam is going to be there with his hand out, right? So you do pay taxes. You pay taxes on the premium. You pay taxes on if they exercise and you sell your stocks at a profit, you pay taxes on that. And these, particularly the premium, is considered a short term capital gain. So it's going to be taxed at your regular tax rate. Well, for us old ladies who are retired, child, we are in a lower tax bracket than we probably been, some of us, when we were working. And so you're going to pay ordinary tax. But if you own the shares and you've held those shares for longer than a year, you will be not taxed at your ordinary tax rate. It's long-term capital gains, and that's a reduced tax rate. So I'm mentioning all of this. Now, y'all know I'm not a tax expert. First of all, I'm not I'm not an investing expert. I'm a Black woman who learned a skill, who is continuing to learn the skill. And I just be trying to sound the horn. Look over here. This is how they making money, and we need to get in on it. We need to learn these skills. So you would, of course, consult a tax consultant. At the end of the year, all the brokerages do it. They will send you a detailed statement of every trade you made, everything. I take my stuff and just turn it over to my tax lady. I don't even bother my pretty little head about it because, hey, ma'am, this is what we pay you for. Figure these taxes out and tell me what I owe. But I just want you to know that there is a tax attached to any time you make a profit in your trading account. Now, there are some accounts that you can trade out of, like if it's like your Roth. Don't quote me on this one, but this is what I read. If you're doing it in your Roth account and that's an after-tax account, you may not have an immediate tax consequence, meaning at the end of the year, you would only have to worry about that down the line when you go to withdraw money. And then that's whatever taxes would apply when you start to withdraw from your Roth. So there's some ways around paying the tax on that, the ordinary tax or the short term. What's the name of it, y'all? When you hold a stock for less than a year, short term capital gains. Okay. So, child, I've talked way above my pay grade today, but I hope that I have piqued your interest in selling covered calls and how you can use them to generate income. It's not going to make you a millionaire, but start small, start in your paper money account. Yes, capital gains. Thank you. Who said that? Thank you, Linda. Yes, it's your capital gains tax. So you've got short-term capital gains. That's on any stock or equity that you have owned for less than a year. And of course, these covered calls, those contracts, that's stuff that we have been in for less than a year. If you own a stock or an equity for longer than a year, I think it's a year and a day, that becomes long-term capital gains if you sell at a profit, and it's taxed at a lower tax rate. Again, I am not a tax professional. I am not. I'm Sandra. I'm a retired teacher who has a love for learning and sharing what I learned. So you all, this is all for entertainment purposes and educational purposes. But I wish you all well. Thank you, everybody who stopped by. Like, share, subscribe, hit the like button. On the way out, hit the like button. Share this with somebody else. Get a Black woman that you know involved in managing her finances. We are sitting on money. If you have a brokerage account, if you have an individual retirement account where you can trade in and out of it, and you're sitting on 100 shares, you could be making extra money and extra income. On that note, y'all, I'm out. I got to get on granny duty, honey. It's time for me to start making lunches and making beds around here. They hire me out. I'm available. I'm going to be here in case I haven't shared with you all. I am not in Malaysia. I am in Chicago visiting my family. This is the first, nobody's known where I've been. I've been here for a minute, but I've just been kind of laying low. I'm not sure if I'm going back to Malaysia. I think my next stop is going to be Central and South America. I want to get over there and see what's happening there. I may very well land back in Malaysia. I think I'm gonna do a video about why I left. And you're welcome. You're welcome. Y'all are so welcome, so welcome. And then I gotta do a video. Me and a panel, we had proposed doing a video, but we had to postpone it about health and wellness. Because while I was in Malaysia, I did a health screening. And as a result of that health screening, I got, they told me, look, get your stuff together. And as a result of that, I changed my eating habits, y'all. I lost about 45 pounds over the course of that year from the time that I took my exam. Yeah, because I took the exam in March. So from March to March, it'll be March in a couple weeks. I lost about between 45 and 50 pounds. It kind of, that last five kind of moves around a little bit. And so I wanted to share the things that I did, and they were practical things. When I tell y'all, everybody knows me. I don't take an aspirin if I don't have to. So no medication. It was simply changing my diet, exercising, sleeping, all the things, hydrating, all those natural things that we do. And so I want to share that with you guys too. So stay tuned. But until then, be good, and I'll talk to everybody soon. Bye, y'all.